All right, so I'm going to say right if you don't know me, I'm Barbara Cholka, and I spent the morning in a dentist chair, so my lip is having issues talking, so bear with me. So I'm excited to introduce Keith Jones, who is actually new to our WealthWay team. He's decided to jump in and join us in this business. He's also our presenter today, and he's located in Jacksonville Beach here in Florida, and he assists his clients all over the country. He's not a stranger to working virtually like all of us, which is great. And his focus in his CPA practice is tax resolution. So we're going to talk today. He's going to teach us a lot about some of the things that maybe myths that we didn't realize, and how he approaches the tax planning. As he says, he helps good folks solve IRS tax problems and restore their financial freedom, focusing on current tax compliance. So what we're going to do today is really understand for our clients what sort of things that we need to be aware of. We're not going to become tax experts today. We are simply understanding some of the benefits of this resource. And some of the things you're going to hear today that we all do, and that would be related to life insurance and retirement accounts, and how that fits into this topic. So we're going to have a question and answer at the end for sure, but I think Keith said, if there's something you're not sure about, you can, jump in and ask a question if you'd like. So does that sound good, Keith?
Yes, ma'am.
All right, well, welcome.
All right, thank you. So if you're sharing the screen, I'm sharing my screen. Can everybody see the slide presentation?
Yep.
Okay.
Yes.
My name's Keith Jones. I appreciate Barbara making me a part of this presentation today. And I don't want to have a presentation as much as I want to have a conversation with y'all. So at any time, you can put your question, raise your hand, Barbara will stop me. I'll stop and answer your question. If you have a question, we'll go along. And at the end, I will include my contact information. Y'all can email me. I'm pretty responsive. And what I want to talk about today is give y'all really an introduction to the tax resolution process. It's I found it very simple, but there's a lot of myths about it. And let y'all know that people do have options for tax resolution, and it's really a formula and I'll get into that in a few minutes, but there's nothing special about it. What I mean to say when I say it's a math formula, so there's certain things that we do, but as we go along here, let me get the thing here. Like Barbara said, I help people with IRS tax problems, and I've been this October, which is next month, I'll be a CPA for 25 years, believe it or not. I can't believe it. But I had my own practice for about 15 years. I went to school at Florida State, and I worked with the Florida Department of Revenue for about 7 years after I got right out of college. And then I worked for a large corporate Wall Street company that's located here in Jacksonville. Y'all might have heard of it. It's called the St. Joe Company. I had at the time, and I worked for them as a controller for about 7 years, and I've been on my own now for about 15 years. Been through my 15th tax season. So I wasn't a CPA the whole time I was with the department, but shortly after I became a CPA, I left the department and went out and worked with St. Joe Company. But tax resolution, it's more about getting people out of trouble. One of the myths is what I found out at the IRS. Really, the people who work for the IRS, they are good people. And there's a lot of myths about working with them, but I've found them to be very helpful. And they're really the good guys in our country. Without them, I think we would have a lot more people cheating on their taxes. That's no better way to put it. And our tax system is really based on people complying, because there's about 15 million people that don't even file tax returns every year. And so there's a lot of political gamesmanship going on between Congress and the president, and has been all the way back to the Obama administration when cuts started being made to the IRS because of political action committees. And that's really what started the spur of the downfall of the IRS, in my opinion. And I think the biggest myth about the IRS is that, you know, compliance and them being able to bring people to compliance, and they really don't have the resources. And I think if they did have proper resources, my business would be better because we'd making people comply more better. And so they're not the bad guys, and that's what I want to tell y'all that people say they are, and they'll try to help you in any way they can. So if you don't take anything away from this, and when you talk to clients that might have a tax problem, or you know someone who has a tax problem, they really should not be afraid of the IRS, because the IRS will help them. And I know so many, and I meet so many people in this country that they're scared to death of the IRS, and they shouldn't be, and they really shouldn't be. The way I do tax resolution though is I'm a little bit different. I you know, God bless them, but I think a lot of tax planners, tax resolution people want you to stay in trouble. That way they keep making money. I want you to get out of trouble, and I want you to stay out of trouble, you know. Therefore, it's like kind of like a doctor. In my opinion, and this is my opinion only, most doctors don't want to see you get well. They want to keep you sick. So you got to keep coming back to them. And, you know, I take on a lot of my clients are ongoing clients because I got them out of trouble, and I keep them out of trouble through doing tax planning. And tax planning is one of the big components of it. Is once you make an agreement with the IRS, you have to stay in compliance. And so, like I told Barbara, most people in today's society, and I know this is the bulk of the people, just raising a family, doing all the right things, setting something back for retirement, getting health insurance, putting their kids through college, such as that. There ain't nothing left over for back taxes. There really is not anything left over for back taxes. And so we'll go through some of the strategies that you might have heard of. And but what I'm trying to tell y'all is when we go through looking at back taxes, the biggest thing about tax planning is to in tax resolution and how they go together and how the two worlds meet is because your future compliance, meaning your current tax liability, not your past, is the deduction against what you can pay in your past. So if you want to get people off the hamster wheel, and I see the biggest mistake I see in most tax planning people, tax resolution, is they want to just jump right into an installment agreement. And maybe not even most CPAs, they don't know a thing about tax resolution. And so client calls them with a tax problem, they say, well, we can get you an installment agreement. That's the easiest thing in the world, I'll be honest with you. According to how much you owe, the IRS will let you make payments. I call them, they'll make even little bitty baby payments the rest of your life. That don't mean you're ever gonna get caught up. And you might not, more than likely, they don't even take your current tax planning into your current tax compliance into consideration. And the IRS knows, on average, within 4 years, you're going to fall out of that installment agreement. So, what that's telling me is that people are entering into payment plans that they can't afford. And I don't want to do that. I want to make sure what I say, whether they can't afford it, it's very obvious if they default within 4 years that they defaulted because they didn't stay in compliance. So therefore, they didn't take their current tax liability into account when they made a plan. Right now, I want to go through some current tax resolutions, some common tax resolution options. And the biggest one is is your installment agreements. It's really pretty easy. A partial pay installment agreement is one, and we'll go over statute, but statute of limitations on a tax liability is 10 years. Okay, that means the IRS has 10 years from the date the tax is assessed to collect on that liability. Now, what happens the majority of the time, it goes through a process, and once a return is filed, the computer takes over. That's what I tell us. It's not a hands-on system. There's a series of notices that are sent out, and then after that, a tax lien is filed. Once that tax lien is filed, they have to, the IRS, somebody has to put a hand on it. They have to put a hand on it to do a tax levy or tax seizure. So it takes some work. So what happens to the majority of them is the computer does all the work, and because of a lack of resources, once that lien gets filed, tax lien gets filed, then it just sits there. And a lot of times, most people, when they call you for with a tax problem, you need to find out why they got a tax, why they want to solve their tax problem. And most of the time, it's because a lien's been filed and they want to get a lien cleared, because they want to refinance their house, or they want to they got some reason they might have got fixed to get married. If they got some kind of something's really compelling them to get a tax problem fixed, and so it's really important to figure out why they want to fix that. But a partial pay, what it allows you to do is make payments on it, knowing that the statute is going to run out before you can get it paid off, and that's a good thing. And we use that sometimes after we do a financial analysis. It's more it's a pretty good strategy when you know there's certain statute is drawn to a close, but you want to once you do financial information, it's called a 433F. You see that there's no way they can pay that liability, but it keeps IRS off their back. So they should pay less the amount owed that's going to ever be owed. And then when the statute runs out, that partial pay goes away. So anybody got a question on that? What a partial pay?
I was just going to comment that sounds very similar to the college loan system that we're all, having access to for our clients. What you're describing sounds very similar as far as not necessarily having to pay off the entire debt, because of the loan forgiveness. But anyway, go ahead.
Right. The second one is a streamlined installment agreement. And what makes it streamlined is the amount that you owe. And because of this COVID, they've actually raised that partial pay, a streamlined installment agreement, to $250,000. And that means that you can enter into an agreement with the IRS without paying any kind of, without supplying any kind of financial information, and just get on a payment plan. And so if it was, they started out with a program where it was 25, then it went to 50, and they just went to 250. So that should give you an idea about how many people are in trouble out there if they've raised that amount. Because once in a streamlined installment agreement, they get people on a payment plan, the IRS doesn't have to touch it whatsoever. No one has to look at a financial statement. And I talked before about resources. So it's a matter of the IRS not having the resources, and they figured out that if they can raise the amount of the streamlined installment agreement, then they can get more people on the payment plan and hopefully get more revenue for the IRS. Otherwise, it's going to sit out there as a tax lien, and they'll never collect anything. A full pay installment agreement is just what it says. And we try to stay away from full pay installment agreement. But if people have the ability to pay their back taxes, and it's all based on a financial statement that I keep referring to, and I'll supply a little bit of information to y'all after this presentation, and maybe get y'all some forms. But a full pay, the offer and compromise is a form 656, but the financial information is contained on a 433. So once that 433 completed, and it spits out at the bottom, like I said, it's a form that it has revenues, it's more of a cash flow thing, it has expenses. If they show the ability to pay, then they're going to have to pay it. Now, I want to stop right there for a minute and tell y'all this. Y'all always remember this when dealing with a tax problem. If you can't pay it, you don't owe it. It's that simple. And you can't pay it based on this formula that I'm talking about. So if you can't pay it, you don't owe it. And that might be counterintuitive to a lot of people, but if you don't have the ability to pay, that's what offer and compromise is all about, is exhibiting that, because what you want to do is stay in compliance going forward. And so if you don't have anything to pay back taxes, guess what? They'll forgive it. And they forgive that based on doubt of collectability, okay? Meaning there's no way the client exhibits or the taxpayer exhibits a inability to pay what's due. And that's about as simple as I can put it. And it's a lot more complicated in a way, but it's not really that more complicated. You just have to exhibit the IRS publishes national standards of expenses. Barbara's talked about some of them in the presentation, but they want to make sure that you're able to take care of your family, and so that's the bottom line. And there's some things that people may not have, like they may not have health insurance. Well, we need to get them health insurance before we go to the IRS, because health insurance is a deductible expense. And I'll give you another example. I've told people, I said, look, you need to go get you a new car, or you need to get your car payment because you don't have one. Well, a car payment, people have to make a living, is a liable expense. And so sometimes you rather take care of your family before you worry about this back taxes, and you need to make sure that you do. And we'll go into that a little bit more. Down liability is usually these last two options are the fewest that are used, but down liability is, say that you you didn't respond to a notice, but you can somehow prove, and it's went so far, it's the only way that you got to try to settle it through the offer and compromise process. It might have been an audit notice, you might have moved, you might be audit reconsideration, but doubtless liability is where you can exhibit that you just don't owe the tax. There's avenues under the code for this IRS offer and compromise that comes into play. And in fact, effective tax administration, and I've got a case right now. It's it's a pretty sad case, but it's this lady in Dallas, Texas, she was scammed, and I know probably none of y'all would let this happen to your clients, but she was with another firm, and this is a 70-year-old woman. And what happened was, by looking at the police report, was some scammers got a hold of her and told her Social Security number had been compromised and stolen, and they found, and they was coming to get her, and she didn't send them so much money. Well, what did she do? She cashed out her daggone 401k, all of her IRA and everything. And so she's got about a $35,000 tax liability because of that scam that she was involved in. She was a victim of, I should better say. And I think they took about $250,000 from her, and we were able to y'all, I'm sure y'all know of if we were able to get about 120 back into a retirement plan because of the scam. And there's a certain letter you can write And you know, we have limitations on how much you put in a year, but under this letter, she represented her broker that she got that back in there. So she does have the ability to pay going forward because she has a pretty good job. She gets Social Security. She's 70 years old. She started drawing Social Security. And she has that 401k. She could in the IRA, Roth IRA, and the 401k. She got the ability to pay, so she doesn't fit into the data collectability. There's no doubt she owes the money, but under the Effective Tax Administration, what we tell them is about, you know, it would make sense to make a 70-year-old lady who was a victim of a scam to pay this tax liability. And what I did was figure out you had to make an offer. What I did was I pulled out I did like I did an immediate return, and I pulled out all of the 401k distributions or retirement distributions that she received. Some was IRA, some 401k. And I figured what she would have owed in tax if she had not pulled that money out, and she owed about $2,000. So we're going to try to take about a $35,000 liability and move it down to about $2,000. And so that's one I've come up with. And so if there's something strange that's happened, then there's special circumstances surrounding the tax liability. It might be a sickness. There's several different ways, but it just don't make sense to collect tax, and there's a way to get out of it.
I have a question.
Yeah.
I've got a client who, used the CPA, had their taxes filed, and 5 years later, the IRS came back and said, "Oh, we didn't get your 2015 tax filing." Is that common? And obviously, there's late fees and penalties or whatever, right?
Yeah, and the thing about there's a first time abatement penalty where the IRS questions nothing that happened. So and the IRS, first of all, never ever, and I've never seen them abate interest on a situation that wasn't offered compromise. But during a penalty waiver, they waive the penalty only, the penalty portion. So if you have a first time abatement penalty, first time abatement to your penalty, well, it's kind of a misnomer, because as long as you filed the last 3 years of your taxes, then you can ask for, and say you filed 3 years and then you missed the fourth one, you can now you can re-qualify for a first time abatement, for what I'm trying to say. So Barbara, in your situation, she would more than likely have to pay, if she had the ability, she'd more than likely have to pay the tax and the interest, but you could get the penalty waived without any question. Now, penalty waivers also are given for reasonable cause. And the thing I was going to tell you is, started this discussion, was you can't rely on somebody else to file your taxes. As sad as it is, you are responsible under the IRS code for making sure that tax return was filed. So, and that kind of sounds a little bit counterintuitive, because a lot of people do rely on CPAs and tax preparers to make sure that their taxes are filed, and especially under today's environment where we do a lot of e-filing, it's mandatory actually. What taxpayers can do is they can, and what I send to my clients is a proof that it was e-filed.
Okay.
So probably what happened was, more than likely, it might have got rejected. It might not have ever been e-filed. I've had them slip through the cracks myself. So, mistakes do happen. I've had one or two. I actually got disciplined because I missed a partnership tax return. One tax return, I was late on it, and I didn't file an extension. I just plainly missed it. I missed it. I screwed up, but it was their responsibility and under the IRS's eyes. My responsibility on the State Board of Accounting, so I got in trouble for it.
Yeah.
And it didn't cost me any money or anything, but I was on probation for a year for missing one tax return.
Yeah.
So she relied on her CPA. She could make a complaint to the State Board. That's like rubbing salt in the wound. You know, people might make mistakes, and
Yeah.
but we're professionals and we shouldn't make them, and I'm aware of that. Does that answer your question, Barbara?
Yeah. Yeah. That's good. Thanks.
Okay. Now let's talk about collection statute expiration date. The way I solve tax problems is a 3-step process. I do a transcript evaluation. Hold on, 3 steps of figuring out what the problem is. That's number 1. Making sure the clients are in compliance is number 2. And number 3 is making a resolution. Under step 1, though, there's 3 different steps. If I was to take on a client, the first thing I would do is get a power of attorney, and I would contact the IRS, and I would do what I call the dogs off. Say, look, don't screw these people. Don't take any collection action whatsoever, because we're trying to get them fixed. And most of the time, as long as the IRS knows it, you work with a tax professional, the tax professional contacts them and stays in contact with them. Usually, what I call that part is protecting a client's assets, because I've seen bank accounts wiped out. That's probably the most common issue that happens, and they wipe everything out of your bank account, everything. But they have to file. They went pretty far in the process, because, like I said, with a lien, a lien has to be filed for any kind of other further collection action, such as a levy or a seizure. And one misnomer I want to tell you is that the IRS hardly ever, and I've seen it one time in my career, they hardly ever take a person's homestead and try to sell it, but they will do that. They have the power to take a person's home in this country to settle your taxes if you ignore them. So that's something really important to know. But the most common action they take is filing that levy, because it's done almost automatically, and then seizing the bank account, because that's almost automatically once the revenue agent gets a hold of it. It takes a little bit of work to seize it, but it does. And also wage garnishments too, and they have pretty common, not only wage garnishments, but the IRS will garnish your Social Security income, and they can only take up to 15% of that. But you know, a lot of folks on Social Security, it's not that much, and 15% is a lot to them. So it's important to and it's important to try to get that garnishment off that Social Security. But a client's statute expiration date is 10 years from the date of assessment. Now, you need to be aware of that, because if he only has a couple of years maybe left on that assessment, you might be able to stall the IRS, and you might be able to enter it into a partial payment installment agreement, like I described before. And so, like I said, the closer you are, and the IRS is much more likely to help and be willing to help if their window to collect is ending. So they know that you they filed a lien. They know that the collection statute date's coming to an end, and they're a lot more flexible when it does come to an end. Now let me tell you something about CPAs, what were known as the IRS's collection statute expiration date. We check that real closely, because there was a report issued by the IRS Inspector General that up to 50% of what the IRS was calculating as the collection statute expiration date was incorrect. So we check those. Now, I told you the step that I took to solve a tax problem, but let me go a little further. After we call the dogs off, the next thing we do in step 1 that of a client is, we, under the Freedom of Information Act, is we get we pull the client transcripts and do a transcript evaluation analysis. Under that transcript evaluation analysis, we check for stuff like CSEDs, their filing history. We get all the information that the IRS has on it. You have to write to it under the Freedom of Information Act. Everything they have, you have to write to it. So we get that. And then we send out a client survey, which I've shown the barber. The client survey that I send out in stage 1 helped me to determine the client's ability to pay the IRS, not pay me, but pay the IRS. And so really that gives us what I call my roadmap to resolution. So we know we've called the dogs off, we got the IRS off your back, we kind of figured out what you may owe with a rough figure, and what you have filed, or what your filing history, everything IRS has on you. And then we also check your ability to pay. So that takes us to step 2. Now, my charge for the step 1 is $1,500 flat fee. And I do all that in step 1. What that does though, and I tell people this, you know what's going to happen. The problem is really solved. It's not, the problem's not solved, but the roadmap is made in step 1. And I'm pretty successful in my efforts to get liability reduced because it's going through the evaluation, and we don't submit offers of compromise if plainly if the client don't qualify. And that's a little bit different than, especially a lot of these real large pay resolution companies. They don't give a crap. They just want to get the man's money, and if you qualify, good. If you don't, good. But I try to go through an extensive process up front before I ask somebody to step off in the deep end of the pool. And you know, what I charge for an offer compromise is based on how much you owe. It's what I call value billing. So a man that owes $10,000, it's not going to cost him as much. And I generally don't want to try to work with somebody who owes less than $10,000. Some people won't work with you if you owe less than $15,000, because the fees for doing so would be cost prohibitive, and you just better off and just making a payment plan and paying never payments. They're paying me because it's going to cost me. It's going to cost you. It's about as much to settle the liability as what you would owe anyhow. And now, when I say that, the amount of work involved is according for revenue agents involved, but it takes me the same amount of work to prepare one, to be honest with you, to prepare an offer and compromise for somebody who owes 10,000 and somebody owes 10 million. And that's what I want to emphasize right now, is how much a person owes has no effect on how much a person pays. No effect. And offer and compromise, which I'll go back to that, when we talk about as data collectability, the IRS focuses on the reasonable collection potential. RCP is what we call it. And I didn't try to teach y'all about that, but they're going to say, what can we reasonably expect to collect? And it's based on the financial statement that we provide that we try to fill out in step 1. So the reason why I feel like I'm so effective in trying to get the tax liability reduced is because we put in good offers and what people can afford to pay, and we try to take a big look at that in step 1. Step 2 is resolution. Step 2 is compliance. That means before the IRS will talk to you, you have to file all your returns. Not only all your returns, but you have to make sure that before you're going to come with tax paying pretty shortly, you have to make sure that you're going to file returns in the future. So if I contribute someone able to get an offer and compromise, compliance has to be for 5 years going forward. So if for some reason you go out of compliance and you don't file your return, then the IRS will make you pay back the full amount you owe. Now I want to talk about tax planning, and I want to give y'all a definition, which y'all can read yourself. But tax planning is really important because I tell people this: it's not planning on what you owe, which it is estimating future tax liabilities, but it's also putting ideas into place that will help you to reduce what you owe the IRS in the future. And I hate to say this because I hate to talk about my profession, because I believe in the CPA profession, but most CPAs you run across, the large majority of them are just filling out forms. And they don't know nothing about tax planning either, not a thing. And so some do, and some do it. It's a do a good job, but for the most part, tax planning is they plan for to make a tax payment, but they don't enact any kind of ideas or strategies to reduce what you might owe. So they might do a pretty good job of telling you what you would owe, but they wouldn't offer you any strategies to reduce what you would owe. Now, let's talk about the client's notions of tax planning. I'll put them in 3 parts, and the beginning usually you find with new clients, or maybe those that never had a professional client. The burn, they might have been in business a while, had some big tax bills, and believe no one can help them. And that's what we find out a lot, which is a misnomer. You can help, and there's a lot of strategies that are kind of skim over here pretty quick. And you have a dreamer who loves the idea of tax planning. Everything sounds good to them, but their enthusiasm may dwindle when it comes right down to enacting a tax plan, or you might get lucky and they may jump in with both feet. And it's a lot about educating that there is things you can do to help minimize what you may pay in the future and help people out. Like I said, tax planning is not tax filing. Now, tax filing is subject to audit by the IRS, and it's really looking in the past. And tax planning is looking into the future, and that's the best way to put it. And it's not just a year-end checkoff item. You need to start tax planning early, because there's some things you can do at year-end. As you know, you can make you might qualify. The person may qualify for an IRA, and they can make that after year-end. And there's a few things that traditionally moving expenses from one year to another may help you. And but it's really not a year-end checkoff item. It's something you should do all along, and it's year-round strategies. And it's also not tax evasion, which we'll go over some of what's considered tax evasion in a minute. But it's a good thing, and the IRS actually encourages it. And like I said, it is the year-round strategy. It's encouraged by the IRS, and it is financially responsible, which is, I know y'all talk about that to your clients a lot. Some aggressive tax planning is legal tactics, but they may feel overreaching due to the amount. There's something called it's coined the Augusta plan. It's where you can find another business and if you have a rental that's less than 14 days, you get deducted the cost of having annual meetings. So, but the person who has that has the place, if the rental is for less than 14 days, they don't have to include the income. So under that scenario, you may have a friend that has a business and may have a second home on the beach or something like that. So you can take and say, have monthly meetings and or quarterly meetings or yearly meetings and a little retreat for your business, and rent a house from your friend they don't have to include his income, but you can include his expense. And if you have a second place, the same thing can happen to you. Y'all can kind of trade off different things, and that's called the Augusta plan. I think aggressive tax planning is necessary to disclose to the client when you feel the aggressive threshold. I use a software program called Tax Planner Pro. It explains to the client, it's client facing, and explains to the client all the risk involved with it, and it does a good job of telling how aggressive you are in your tax planning. In extreme cases, you can get an IRS ruling. It costs a little bit of money to do it, but the main thing I wanted to press upon y'all is aggressive tax planning is legal. It's not illegal. We're not trying to do nothing illegal, and we're trying to stay in compliance. We just want to minimize what you might owe in the future. Tax shelter scam is clearly illegal, and something is doing something clearly illegal or something that would be challenged by the IRS. What we want to do is we want to stay in good graces with the IRS. Some plans are illegal, some are just frowned upon. And most of you just sold by companies claim it's specialized, and if it usually it's questionable if the sole purpose of the tax shelter is to avoid tax or reduce income tax, then it's probably it might be it's the sole purpose of it. And I know that lately some of the things that the IRS is frowned upon is some of these conservation easement partnerships. Y'all might have heard of people investing in them, and they're really just tax shelters, and it's been deemed so by the IRS. Now, I won't try to go over all this, and because it'd take 3 or 4, 5 or 6 presentations. It's actually about a 25-hour training for me to learn this, but I try to put these tax planning ideas into big buckets. And some of them that they may have heard of is you separate your 401k, S corporation election, buying a bigger house so you get a bigger mortgage deduction. You might lease a business car, increase your charity. And a lot of people don't know about this one, but if you have children over 7 years of age, you can put them to work. So instead of giving them an allowance, put them to work. It's tax deductible to you up to $12,000, but it's not taxable to them because everyone gets a personal exemption. So even if you claim a child, you can still take the deduction, and it's not income to the child. So that's how you get around that. And
I like that one.
Yeah, and it's really a big bang idea, Barbara, when you employ children with a 401k. So you can it kind of falls over in the next bucket when you can if you have enough money, enough cash, and you make enough money doing it well enough, you can set up a 401k plan for your clients and employ your children and add a 401k deduction to that. So you get a big break there. Other big bang ideas is when you might defer your income. And so if you're planning year round and you come up towards the end of the year, you might put off your billing for a month or so. And you don't really need the money, but you can have to pay tax on it, but you can defer it. Same way you can increase your expense or accelerate your expense deduction. So you say in 1 year that you have a bill, but it's not due till the next year, you go ahead and pay it and reduce this year's tax liability. So it may not be due till January. You may have 30, 60, 90-day terms, but you go ahead and pay it because you have the cash. It's deductible in the current year. SEP IRA, 401k, y'all pretty familiar with those ideas. A lot of people are not though. Pension plans, defined benefit, they would be deductible. A cost segregation analysis. That comes in and it's pretty big, and it's not, some of y'all may have heard of that, but when someone builds a building, there are parts of that building that are when you have real property, it's deductible generally under not such a building. It's deductible according to it's a residential or commercial. There's different lengths, but it's deductible over a long period of time. But like a motel, for example, you might have got one bid for the motel to be built, and furnished out, say it was $10 million. Well, within that $10 million, you know the beds are gonna wear out. It's just air conditioning is gonna wear out before, you know, in a short period of time. Carpet, such as that. So what you have is you have an engineering firm go in and do a cost segregation analysis, and what they do is submit a report and say, out of the money you spent, this should be 10-year property, this should be 5-year property. So you're able to accelerate your depreciation a lot sooner than you would if you had the whole cost over the life of the over longer term, such as 30. Some of them can go up to 37.5 years. You know, commercial building, for example, and you have a residential property is a long time. It's less than that. Like, try not to remember numbers, just remember concepts. I can't really tell you exactly right off the top of my head. And another big bang idea is the second home. Now, some of the things that folks never knew would be the 14-day home rental, and that's the Augusta plan. And I talked a little bit about, and you have to have, that's where you can rent your home for 14 days or less, and you don't have to claim the income. But if you do a rental, you can, and use it for business purpose, and then you can deduct the expense. So business, like I said, you might trade off with, it occurs most frequently in closely held businesses, but most people have never heard of that. And it's not a big bang idea, because it's generally not, it doesn't save you a lot of money, but it may save you a couple of $1,000 a year. And where I was raised, every penny counts. Section 179, some of y'all may have heard about that, but it's a pretty popular deduction. And what that allows you to do is to take fixed assets, and instead of depreciating them over a period of time, you can take the expense of that fixed asset and deduct it in the year that you bought it. So any CPA worth its salt is generally going to be aware of that deduction, but that don't mean everybody is. Tax-free municipal bonds is something else you should be familiar with, but that, you know, you can invest in some bonds that are not taxable, and so then most people have never heard about the employed children part, and they might have never heard about the auto leasing. Some of the more partnership sale loan is a little bit more complicated, and a gift leaseback trust is a little more complicated, but they're out there. And I included on here self-employed health insurance, and it's a deduction that it's allowed. It's budgeted out under a tax resolution. It's allowed under a it's a good tax paying idea. And if people have cash, there's no sense in them going uninsured, because it is a deduction that you can't take on your tax return if you're self-employed. Has anybody got any specific question about any of those that they'd like to go over?
Section 179, when you're talking about taking the deduction in the same year, is that taking all the depreciation? Or
Yes.
okay.
There are some limits for bigger corporations that buy a lot of equipment, but for most small businesses, they're going to qualify for that Section 179 deduction. And it's according, the limitations are based on the amount of income and the amount of property that you put in service. So, but I think they've raised the deduction to about $500,000. So you have to be a pretty big corporation not to qualify for the deduction.
Mm-hmm. And the last one is the employed children with 401k? Like,
Right.
can you elaborate on that a little bit more?
Well, it's like any other. It helps them start building when you contribute to a 401k, which you can if you have an employees. And so what you do is you employ your children, and then you start the 401k. You get to take not only the deduction of employing your children, but you also able to take the deduction of
The business.
401k plan. So it's two-way deduction, both deduction for the wage and tax and the wages spent for your children, and the deduction that you get for 401k. So you can, they're fully employed, you can fully take that deduction. For me, it's pretty simple. It's not really. You can really get a bigger bang for your buck by doing that, by adding on that 401k deduction to your children. So you first make them aware that you can employ your children, and then if what we have under this tax fund program I use is a path to zero. And if you're willing to make these implement these tax strategies that we offer, you can actually get your tax liability to zero, but you have to implement some of the planning ideas, and so that's fully allowable. And I hope I explained that to you well enough, but it's not really fancy. It's just deducting the amount that you contribute to your employees, which in this case is your children, 1K plan. It helps them at a young age to start investing for retirement. And with the way money in your finances, the power of compound investing, the return on that is very great. So if you can get someone, especially children, that you want to leave behind, if you can invest in 401k when they're 6 years old, that amount can really compound over time. I mean, because I know that y'all pretty aware of the compounding power of money, but the earlier you get started, the better off you are. And if you get somebody 7 years old and start investing in 401k, then you can see where that would start compounding pretty quickly. Did that answer your question?
Yeah, it did. So they are minors, and do they have the file taxes, or is it just because they're minor?
Well,
Like, how would that work?
let me explain that a little bit better. Every person who files taxes gets a personal exemption, and they get a standard deduction. Okay, so what you want to do is you want to support the children, and you as a taxpayer are going to use the children's standard deduction. Excuse me, you're going to use their personal exemption. Okay, but you don't get to use their standard deduction. Okay, so say the standard deduction $12,000 is a loss. So so you could pay a child at $12,000, and they don't have to pay any tax on it, because $12,000, the first $12,000, let me slow down a little bit. The first $12,000 that you make is not taxable whatsoever. Anybody makes. Okay, so when you pay your child, you can deduct it as an employee expense. The child would need to file a return, but he wouldn't owe you tax. Does that make sense?
Mm-hmm.
Yeah, because his first $12,000 worth of income would be tax deductible.
So they do
Thank you.
file.
And I'll send out some more information on employed children, because that's probably one of the easiest one. And if y'all can couple employing children with the 401k, then I'll make available a little bit more information on that section for y'all. It probably explains it better than I can. Anybody else got any more questions? All right, let me see. Okay. Now, tax planning is going to be your best defense. And, you know, what I found out is sketchy tax positions and mistakes are the biggest cause for people who's angry at me. And if I offer tax planning to them and they don't take it, then they ain't got no reason to fuss and complain and bitch and moan about how much tax they owe because they had an opportunity. Mistakes, like I said before, I made mistakes before, but having a good process keeps them to a minimum. And sketchy tax position comes out when the client freaks out over tax due. And what that means is that you didn't plan, because if a client freaks out over how much he owes, then that means he didn't plan for the liability, and all of a sudden now you get his return ready, and you show how much he owes the tax due, then you might try to come up with some kind of sketchy tax position. And CPAs should use tax planning to initiate strategies and ideas before you have his client planning. And you want to make sure documentation is prepared and ready for the tax season, and don't scramble to the end to find more savings at tax time, because usually it's too late. And really, really and truly, you know, tax planning must be a year-round activity. It doesn't happen in a vacuum. It does happen overnight. And I use a software program called Tax Planner Pro, and I won't try to, but it's a pretty comprehensive program. It allows you, Barbara's looked at it herself, and it's pretty snazzy, and I have a subscription to it. So anybody who's interested in tax planning, you know, I can try to help you. And believe me, I'm free with the information. So any of y'all got any kind of questions, any specific things that comes up after this presentation's over, y'all contact me. Please contact me, and I'll try to help y'all at least.
And I think especially our clients who are business owners, independent contractors, you know, realtors, people who are obviously 1099 income, those are the ones that are most at risk, would you say?
Yeah, I would. And, you know, a lot of, you know, before we went back to the S corporation under, I hate to see people file Schedule C because they have to pay tax, self-employment tax on all of the income. So one of the top small ideas is to make an S corp election. Under the S corp election, Barbara, you have to file extra return, but you only have to pay self-employment tax on what you pay yourself. So let's just say that you've taken $100,000 out of the entity. You have to pay yourself what the IRS deems a reasonable compensation. So let's just say, okay, we'll say $50,000 of that is wages, and $50,000 that's distribution. Well, you just saved $7,500 right there, because you don't pay 15% on the amount you deemed as a distribution.
Yeah.
I mean, just by making a tax election, you save $15,000. So the S corp election is, you have to be incorporated or an LLC, so most of, if I see somebody that has a Schedule C, we look at how much they're making, and there's no, I think nobody really settled, but you know, if a client's spending $40,000-$50,000 at the end of a Schedule C, anything over that, then he probably needs to be looking at S corp election.
Yeah.
You know, it's available for everyone. And what happens is all of the income and all the expenses pass through to the individual, and the corporation is not ever taxed under that. He just has to file what's called the information report that reports how much wages and how much income. It's more or less, it's a tax return, and it's going to show you income and expenses of the S corporation. But the client is issued a Schedule K1, and he has to report that on his individual return, and to show how much distribution, how much income. But you're only going to be taxed for separate. You're still going to pay income tax on the full amount, whether it's S corporation or C corporation. But savings comes in is between the wage, how much you take out, and you deem as wages, you pay self-employed on that, which is 15.3%, and the amount you deem as distribution. And there's companies that make out what's reasonable, but I don't take advantage of those companies, because me as a client can usually work out what's reasonable. But certainly, if you have someone who's taking out $100,000, that it may be reasonable. Where I've seen clients get in trouble, Barbara, is when they deem everything to be non-wages. They make an S corporation, and they don't take anything, and they don't do any payroll tax reporting whatsoever. And so they don't pay any payroll tax. So in the same scenario that I just said, they may take $100,000 distribution and not take anything out as payroll. They think they save themselves $15,000 by doing so, but the amount of compensation should be based on something that is what the IRS deems reasonable.
Yeah.
And I usually ask the question to the client is, what would you have to pay somebody else? And it's only for services that the client provides to the corporation. So what would you have to pay somebody to do what you do? That's what I usually ask them. And whatever they tell me, I say, well, then that's reasonable. And let's deem that much as they use to pay them a monthly wage, out of the payroll, but we usually farm that out, but that's what we do in that case. Does that make sense?
Yep, absolutely.
Yeah. Anybody else have any question on the S corporation? Everybody aware of that? Because that's one of the first ones we look at.
Yeah.
Barbara, I'll end now. I think we've run about an hour, but we want to leave a little time for any kind of questions or discussions that people may have. Then the next slide is my contact information. The best way to get a hold of them is by email me a question, and I'll get back with you. But
I've already got 2 people that I'm going to ask you questions about and maybe send your way. So, and they can be in any state, correct?
Yeah. One thing about a CPA, we licensed by the state that we usually live in. And most people have a couple of states, but when dealing with tax issues, I'm licensed to practice in all 50 states by the IRS. And so it doesn't matter where you're at, we can usually help the client. And I have clients from California to Washington to Vermont. I have clients literally all over the country that look for me to help them.
Okay. Well, that's great. We appreciate it. Anybody got any last minute questions? You've got his contact information. And I guess, Sean, are you trying to speak or are you unmuted? Okay. Well,
I don't want to hold up the call, but so I'll set up something up separately to talk to you guys. I appreciate it, Barbara. Thank you.
Okay. All right. Well, appreciate it, Keith. And we're, excited to have you on our team. And well, we learned an awful lot today.
All right. I hope it was beneficial to everyone. And again, I'm gonna make these slides available to y'all. I don't have them available right now, but we'll get them to y'all. We're also gonna get something out to y'all about important to children, and the IRA to the children as well.
All right, that's great. Okay, well, thanks again. I did record it, so I can share that with you as well. So,
all right, I appreciate y'all.
All right, well, have a good rest of the day, and thanks everybody for joining us.
Thank y'all. I appreciate y'all joining us.
All right, take care.
All right.